Question number 3 of AFM pre-September 2025 mock exam. So this question is on, as you have guessed it right, that it's on risk management. So we will see in this question whether it is exchange rate or interest rate. Okay. So first we are going to go through the requirements. So there are two requirements and this is also a 25 marks question. So first question, you have to discuss the possible reasons for the board's decision not to use options on interest rate future as a hedging method, even when upside potential would provide a significant cost saving. So here you have to talk about why they will not go for options. Basically, you have to discuss the disadvantages. It is for 5 marks. So for risk management question, you have to make sure that you know the advantages and disadvantages of all the hedging tools. That is future, forward, swap, option. Okay. Next, this is for 15 marks. Okay. And you have to recommend a hedging strategy for 21 million loan. So it's a loan based on the finance director's assumption that base rate may rise to 7%. You have to support your answer with discussions and calculations including rates at which payments between counterparties should be made. Okay, so all your professional skills will be tested here. Same like question number 2, except communication, because you can write your answer in any format. But any format means you still have to present your answer in a logical order. You cannot show it in a very haphazard manner. Okay, it has to follow a logical order. Now, so I will take you through how to answer risk management questions. Let me tell you, this question, risk management, is the most risk-free question. Okay, try to get the maximum marks for this. Often students choose this as the first question because this is the easiest, and if you see the nature of the questions, they are very standard questions. You will often see similar questions on risk management compared to net present value and acquisition merger, where questions could vary a lot. But risk management, often you might be given some investment or either a receipt or a payment, and you will be told to hedge using various methods and then finally conclude. That is the basic structure of risk management question. So we will start by going to the exhibit, and so let's see, we have to fix this. Why the exhibits are not opening? Let's see. So exhibit 1. So in exhibit 1, they are saying that what the company mainly does. Okay, and here also it's about the government that controls the company, and they are the only shareholder. So the Department of Housing is the only shareholder, and they are providing capital through government grants every 9 months. So this project is controversial and has been widely criticized in the media for its cost exceeding its budget. Now, the directors were recently replaced due to these criticisms. So now they have introduced a new reward system to prevent further cost overrun, with the generous bonus system for the directors if budgets are achieved. Now, not too much of information for me to do my questions. But what I need is exhibit 2 mostly. So here you'll be given today's date, that's 1st Feb, and you are borrowing 121 million on 31st May. Loan will be repaid on 31st October. That is after 5 months from May to October, and you can borrow at the base rate plus 20 basis points. So you are borrowing at what rate? Variable rate. Base rate is currently 6.2%. Okay. So looking at this, you can see that this is an interest rate risk management. It's not an exchange rate, it's an interest rate. That's why you have been given the base rate and all those things. And often students do not do good in interest compared to exchange rate. Let me tell you this. This is based on experience. Why? Because interest rate, remember, it is easier than exchange rate. Because interest rate, you only have to deal with one currency, but in exchange, you have to deal with two currencies. That conversion becomes difficult, but in interest, it's only one. But the reason why it's difficult is lack of practice. Students often practice on the exchange compared to interest rate. So make sure that you practice on this area. Since this has been asked in the mocks, you have a higher chance of getting an interest rate risk management in your question. Now, so as you all know, it's about interest rate varying, and they, because it's a borrowing, their concern is whether interest rate will rise or not. Okay, so they want to see of an increase in the base rate to 7%. From 6.2, they are concerned if it increases to 7%. But it could be other way around also. Base rate could fall also. But since you are borrowing, see your position, you are borrowing here. So you will not be concerned about the fall. You will be concerned about the rise in interest rate. Okay. So the board is highly risk averse. Okay. See all this risk averse and all this risk appetite you need for your discussion question, not your calculation. When you have to link which method are you choosing for hedging, that time you have to use this information. You understanding? Whether it's future, forward, or option or swap. Okay. So here you have been told to investigate the advantages and disadvantages of interest rate swap. Okay. And also to rule out options. So they do not want to go for options. Even when we know the upside of options is huge compared to the other. If you go by the other hedging techniques, that is forward, future, swap, your upside is limited. You can't gain so much. Yes, you can reduce your cost. You can eliminate the risk up to a certain level. But it's like there's a floor and a ceiling. But in option, it's not like that. You can get, if there's upside, you are going to get the benefit by not exercising the option. Okay. And if it's downfall, you can hedge exercising the option. So you benefit both. But for that variability for options, you have to pay a huge premium. Okay. Now, so these are the following three techniques: forward, future, swap. See, for risk management, whether it is interest rate or whether it is exchange, you are often given 2 to 3 methods. You will always be given 2 to 3 methods. Why? Because you have to compare among them. Mostly it is 3 methods. They will not give you more than three. It's either 2 or 3, but not one, because you cannot compare. So that's why you have to know advantages and disadvantages of each of this method. Okay. Forward, if you see, mostly forward, future, and options, they are very common. Okay, swap sometimes comes, sometimes does not come. But interest rate swap, if it comes, okay, I know a lot of you right now are praying that I hope that interest rate swap does not come, because it is often tricky. It looks, it's difficult, but trust me, interest rate swap is the easiest. I will tell you how. Okay, so once at the end of this video, you will find interest rate swap very easy. No matter whatever questions you get on interest rate swap, you will be able to tackle. You just have to follow with me. Okay. So now these are the information given. So the rate is given. The net borrowing cost is 595,000 with an effective annual interest rate of 6.8%. They have already given it for you. They have calculated and given it for you. You don't have to find the net borrowing cost. It's already given. And they have also given the interest rate also 6.8%. Now you have to compare under future and swap and compare this with this FRA, future and swap, and see which one is giving you the lowest cost, because it's a borrowing. So you have a 3 month future, dollar future. Okay. Futures are 3 months only. And the contract size is 250,000. And we all know the basis is 100 minus annual percentage yield. Remember, here you have to decide which future are you going to take, March, June or September. For that you have to go back and see when are you borrowing. You're borrowing 31st May. So you will expect to exercise the June future, this one. Why? Because after May is the June, the next one is June. You can take September also, June and September, but June would be better one, because your basis risk will be lower in June. You will always try to take it closer to your borrowing period. Not March, because March is expired. You are borrowing in May, so you can't go by March future. That's how you decide on your futures, okay? This is always fixed. This is how you will be tested on future. First you have to decide. Then you have to find out the closing future price. Then you have to find a gain or loss in the future market and get the net amount. Okay. Next, swap. Swap also, you will always be given fixed and variable of both you and the counterparty, and then you have to see where you are getting higher, more gain, whether it is under variable or fixed. and then work on the swap that I will teach you. Okay, so here they have identified a counterparty. Counterparty can borrow at base rate plus 1.4 and fixed is 7.4, and for D company they can borrow at the fixed rate 6.9. Remember here they did not give variable rate for the company. Why? It's given here. They have already told it's base rate plus 20 basis point. So that you have to take here. And the gain is split equally between the two parties. Okay, so what's next? Immediately start and attack your three hedging techniques, that is forward, future and swap here. Okay, so for FRA you have to write it here. You will choose the word processor and FRA. Okay, make sure that you are writing it in bold so that you know that you are writing here the net borrowing cost of $595,000 and the effective annual interest rate of 6.8%. This is already given. Now let us go to futures. Often when they give you three, they often do for one, and mostly you have to calculate only for two, like here. Okay, but if they give for two, you have to calculate for both. That's how it works. Now remember, for future you have to first decide you are hedging against interest rate or fall in interest rate. You are borrowing, so you are hedging against an increase in interest rate. So when you are hedging against an interest rate, you have to decide whether you are selling on future or buying the future. That means short or long. This is a borrowing. You are going short in future. Okay, so you have to write this proper terms. Okay, hedge. So you have to write all this. Hedge against an increase in interest rates. Do not assume examiner will know this. Okay, you have to write it. For this you are going to get marks. Okay, these are some easy marks which you can throw away simply by not stating all this. You have to write it. So therefore go short in future market. Whenever it's a borrowing, that's a rule. I have mentioned in my lectures also under risk management, interest rate risk management, that if it's borrowing, you have to go short in future market. Now, you always have to mention which contract are you using, March, June or September. That also you have to mention. So use June contracts. Why you are using that contract, you have to mention the reason. So use June future or contracts as fund will be required on 31st May. You are going to borrow when? 31st May. So funds will be required on 31st May. Now, next, you always have to find the number of contracts. So these are some fixed methods. You see any question until now that you have done. If you have done the revision kit properly, all the questions on interest rate risk management, you will see this formula, this method. Always it's whether short or long on future, whether which month contract are you using, and the number of contracts. Okay, and if it's in decimal, you need a round figure. So the number of contracts will be equal to, okay, this you can use Excel to find out, or you can simply use a calculator to find out. Okay, I would use a calculator here. So my amount that I have to borrow is 21. Here you don't have to worry about the currency. Everything is in dollar. So 21 million. I omit the million. See, you have to be smart enough. Okay, if you keep on adding zeros, it's a waste of time, I would say. Okay, at least when I used to calculate, I don't write all the zeros. I just simply write the amount and divide it, because I know zeros will be cancelled. But if you want, you can write 21 million. Okay, So 21 million divided by 250,000. So when I'm writing 250,000, it's 0.25. I'm just dropping down the millions. The zeros I'm just dropping down. It will give you the same answer. You can try it out and see. Okay. You can click from here. Okay. I'm going to put a bracket here. Let's first put a bracket. .25. Close the bracket, and then you have to multiply by number of months. How long are you taking it? Okay. So it is for 5 months from May to October, and then divide by the number of the future contract. Future contract is always 3. Always 3. So only for 3 months. Enter. So it's 140. So what is the number of contracts? 140. Okay. Now, because it's future, remember you have to find the basis risk. You always have to find the basis risk. They will never give you that. So basis. Okay. How do you find the basis? Follow this formula. It's always spot minus the future price. Spot price. Always write these things so it makes life easier. You know what you're actually calculating. So it's spot price. That means on 1st Feb. Spot price means was today's date. They will always give you today's date in your exam. So it's 1st May minus the future price, the opening future price. This is also given to you. What are you simply doing? Why are you finding basis risk? To find the closing future price. Because you are given the opening future price, right? If you do not find the closing future price, you can't find a gain or a loss on future. You need that always. Is equal to basis. Remember, it's not the other way around. It's always spot minus the future price. Spot minus the future price, not the other way around. Otherwise, your sign changes, positive, negative. Okay? Sometimes gain will be loss, loss will be gain. Then do not confuse yourself. Memorize it this way. Now, what is your spot? Okay? Your spot is, go back here. See, it is 6.2% base rate. Okay? And to find the basis, they have given is 100 minus the annual percentage yield. That's how you get all this. If you want to convert this into percent, just minus 100 by 93.35. You will get it in terms of percentage also. So what is your price? Opening future is 93.35. But if you see the spot rate is given as percentage, first you have to convert it into the future price. So that's why 100 minus 6.2. Again, I'm using calculator here. So it's 100 minus 6.2 here. This is the spot, 93.8. Minus the opening future price. You can use your exhibit too. It's 93.35. Okay, this one. So it is 0.45. Okay, and this 0.45, it is going to, you need the unexpired basis. Remember, you want to borrow in May and you are taking the June contract and it expires in the end of June. So from May to June, it is 1 month. Out of the total 5 months, you have to take from, when you are calculating the duration of your loan, it is 5 months. But unexpired is only 1 month. May to June. So 1/5 of 0.45 you have to take. Or just simply divide it by 0.5. Not 0.5, sorry, divide by 5, I'm sorry. Into 1/5 or divide by 5 is the same thing. I could just do into 1 divided by 5. So it is 0 0.09. 0.09. Okay, but I will show you the working here still in case you need it. It's 100 minus 6.20 minus 93.35 equal to 0.45. An unexpired basis on 31st May is equal to 1 month out of the total 5 into 0.45, which is equal to 0.09. And even this number of contracts I will show how we have got here. So it's 21 million divided by 250,000 into 5 divided by 3, 5 months into 3 months. 140. Done. Now, what do I need? Now I will find out my annual interest rate, effective annual interest rate for future, and also the net borrowing cost if I use the future. Because I've got all the variables that I need. So now, if base rate. See, sometimes you might have to write both the situation, increase and decrease. But in this case, it's only increase, one side. So if basis rate, sorry, not basis rate, base rate increases to 7%. Make sure this is in bold, it's highlighted. What is the impact on the future? You have to find the interest payment. It's a loan. So you have to find the borrowing cost of it. So what is the interest payment? Of course, the cost would be interest that you have to pay on the loan. So what would be the interest that I have to pay? Here, okay, I will do a calculator. So the interest, see, you can borrow at what rate? Base rate plus 20 basis points. So what is the base rate? Now base rate is 7. That means 7 plus 20 basis point. 7.2%, right? So, and the loan is 21 million. For 5 months you are taking. So you are finding out 7.2% of this one. Okay. You can use your Excel also. Doesn't matter. I think Excel is better compared to calculator because it stays any working in there done in the Excel stays there, as well as it's quicker than using a calculator. Okay, at least I feel it. So here it is 7.2% into 21 million into you have to expand it to see the whole number. Okay. Remember, it is not 21 million also when you're working out on the future. Why? Go back. You have found out the number of contract and you know the contract size. So you are hedging 140 into 250,000. So 140 into 250,000. And this contract you are taking for 3 months. So 3 divided by 12. So this you will get it at 7.2%. 630,000. So this is the figure that I need here. Interest payment 630,000. Now, what's next? It's an interest payment. You need your future gain or profit. If it's a gain, you will deduct it from the interest payment. If it's a loss, it will be added. Of course, it's a gain. Okay, because your gain in the future market will be offset by a loss in the spot market. Okay, so that gain we have to find out. Now, you have to find out the closing future price. So, closing future price. We have to find out. How are we going to find it out? It's simply 100 minus what is your base rate now? 7%. Okay, 7.0 minus the basis risk, unexpired basis risk 0.09. Do not forget that. That's the whole point we have calculated there. So you can just straight away, if you have shown like this, you can use the calculator. So 100 minus 7 minus 0.09 and enter. It is 92.91. So 92.91. What is your opening future price? 93.35. Closing future price is 92.91. So you are gaining here. Okay, the difference is the gain. So here profit on the future market. This is how you calculate. First you take the opening future price, that is 0.9335 minus. So this basically you are converting it into this thing, 0.9291. You have to multiply this with the contract size, 250,000. Always contract size you have to multiply, and also into 140 contract, number of contracts, 140 into how many months? Profit on the future market. Future you are taking for 3 months. So it's always 3 divided by 12. So this if you do here, 0.9335 minus 0.9291 into 250 into 140 into 3 divided by 12. So it's 38,500. This is the gain you have to deduct from the interest payment. 38,500. And then net borrowing cost. Get your net borrowing cost. But if you write it like this, it's not very clear cut. So you can just write, it is simply 630,000. Just copy here, paste, minus 38,500 and get the amount. So 630 minus 38,500. Enter. 591,500. If you compare this with the forward the cost is 595. Here is 591,500. So which one is more? Forward is more. So in this case, future would be preferable. But we'll have to find out the effective annual interest rate. Why? Because in the forward they have given you the effective annual interest rate. So to compare, you also have to find for future. effective annual interest rate. So it is simply, how do you find the effective annual interest rate? Remember this. Since you have got this, the net borrowing cost 591,500. So it's 591,500 divided by 21 million. The amount of loan that you have taken. This is the interest over your loan into, not 5 divided by 12, it's 12 divided by 5. For 12, total is 12 months, and for 5, because the loan is for 5 months. So if you take it in terms of percentage, if you convert this, just multiply it by 100 to get in terms of percentage. 6.76%. This is also less than this. Forward, if you go forward, is effective is 6.8 and this is 6.76. Difference is not so much, okay, little. Now, another thing students often ask me is this part. How do you know it's a gain or a loss? This gain and loss. You remember your position. In the future, you are going short. Short means you are selling. Long means you are buying. So you want to sell at a this one. So if you look at the price, you might get confused. You might say this 0.9291 is less than the opening. So why it's a gain? Do not look at the price. Look at the interest rate. So if it's at 93.935, okay, so it's 100 minus 93.35. In terms of interest, it is 6.65 opening, and the closing would be 100 minus 92.91. It is higher, you see. So you are selling it at a higher interest. If you take in terms of interest, it's higher. If you look at in terms of price, yes, it's lower. So you are selling it at a higher interest. That's why it's a profit. Now do you understand? You are buying at a low, selling at a high interest. But if you take it in terms of price, it's the other way around. Then you have to think in other, the lower the price, the better it is for you. Because the lower the price means high the interest rate. You are selling at a higher interest rate. You understand? Now is the challenging part. So we have finished the two things perfectly. Forward is done, future is done. What's next? Swap. Swap. You have to clearly always label which option, which technique you are applying. Like this, you have to bold out. Now we are in the swap. Of course, leave some space. So when you're dealing with swap, always write the fixed floating rate and the two parties and the difference in the fixed and the floating rate. And whichever is having the highest difference is your competitive advantage. You have to choose that rate. This is how swap works. So now here we'll write the fixed rate of both the parties. Fixed rate, or you can have a table also. I think table would be more preferable in this case. Okay, floating rate. There are many ways of presenting this. Either you can use Excel also for this. And it is the D company. So D company and K company. K company, K is the counterparty, by the way. D is the company that you are working on. Your question is on D company. And finally the difference. Okay. And the net saving. Okay. So what is the fixed rate for D company they have given? You can always open this and see. It's 6.9%. 6.9%. And what is the fixed rate for K? It is 7.4%. Keep this also. Who is having advantage here? D in the fixed rate because lower fixed rate. The difference between the two. 7.4 minus 6.9. 0.5. Next, floating rate. So floating rate for D is base rate plus 0.2%. Now, okay, base rate plus 1.1%. So if you take the difference between two, the base rate will be cancelled. So you will only be left with 1.1 minus 0.2, which is 0.9%. You don't even need so much of time to calculate this. Some things are very easy. So wherever you can just calculate manually in your mind, do not waste your time to use a calculator. But if you think you need a calculator, you cannot rely on your own calculations, use a calculator. This saves a lot of time. Okay. Here also, if you see who is having the advantage, D is having the advantage in both fixed and floating because he's having the lower fixed and floating compared to the counterparty. But the higher difference is in the floating rate. So D should go for the floating rate. This is the decision of swap. D should go for the floating rate under the swap and K the opposite, of course, fixed. So if you see the difference between these two, 0. The total net saving, it is 0.4%. Okay. This is the net saving. So you need this net saving because you have to split equally among the two parties, this net saving. You need this. Okay. Now, so you have to write the sentence under swap. What is your decision? So D has an advantage. So in your company, if you write D company or K company, you will still be given full marks because make sure that both does not have the same initials, where it's very difficult for you to identify which company you are referring to. In case if you are running short of time, since this is the last question and it's very common, most of you will be running short of time. So if you do not want to write the full name, you can just write D company because there is only one D and one K. Okay, it will be understood that you are referring to Darveston company. So they has an advantage. Sometimes it might not always be the case. Sometimes one party might have advantage on one rate, the other party on the other. Then it's difficult. Then you have to see who is having the higher difference under the rate. In this case, it's easier because D is having advantage in both. But the higher difference is in the floating rate. That is this 0.9 compared to 0.5. This is you need. So has an advantage in borrowing at both fixed and floating rates. You can write variable rates or floating rates is the same thing. Do not emphasize so much on the terms that is used, okay? But you have to write this decision, by the way. Otherwise, your swap calculation will not be understood. But the floating rate advantage is greater. You see how easy it is, okay? So swap is nothing to worry. This is very easy. I'm sure most of you have understood until this point. The trickiest part is in the last one. How to find out who is paying what and who's receiving what. So we'll do that part. Here what you have to do, okay? So here I would use Excel to do that. I think it's easier in Excel. So this is D company, this is K company. Okay, and sure that you make it little bold. And first, always start with rate without the swap. This is better. Okay, always start rate without swap. See, what was your decision? That with the swap, D would go by the floating rate. So without swap means they will go by the fixed rate. The other way around, he will be at the disadvantage position. So 6.9%. You understand? So D will be at the fixed rate and the counterparty K would be at the floating rate. That is base rate plus 1.1%. Or you can just simply write B plus 1.1%, 1.0%. Okay. Now savings. Next stage. So this is the first I will write. Do not write these numbers. These numbers are only for illustration purpose. I'm just showing you how to work this out. Okay. First, always without the swap. Second, the gain that will be split, or you can say saving is on 50-50 basis. Always write the basis. So in this case is 50. What is 50-50? This one, this 0.4. So this 0.4 if you divide by 2 equal to 0.4 divided by 2. So 0.2. 0.2%. No, if you turn it in percentage, wait a minute. You can always do undo. So 0.20%. So if you want to show this, go here, go to custom, and you have to go to number, click this. Okay. Now it's the same. If it's the same, just copy paste. Since this is a disadvantage, this is a gain. Your gain will reduce. So you have to deduct the gain from the rate without those swap. So the net third is the net result. This, make sure that this is in bold because at the end you have to get this net result only. So how do you get it? It is simply this minus this. This is why I say this is better. But if you're taking it as a percentage, convert this into percentage. Okay. Yes, done. And this is also in bold. But see, this is a payment. Okay, this net result has to be in bracket. So in case if you want to show this in bracket, make sure that you are writing this as minus. Why this is showing minus? Because then you have to add the gain because this is minus. Okay, if you deduct from a negative figure, if you are deducting something, the number is added and it becomes even bigger. Okay. So what you have to do is here, in that case, if you are putting a bracket here, you be very careful. Okay, if you are putting a bracket here, then you have to use the sum function. Automatically they will deduct that, this too, and you will get this result. But if you are not putting the bracket, let's say you have omitted the bracket, then you have to deduct it and convert it into a negative figure because it's a payment. Okay, but I would prefer writing this way, putting it in negative because it's a payment. So next to this I will just show it minus, and I will just use simply the sum function. This is easier, I feel. You don't have to worry about the sign change. Next is the same thing here. Okay, Let's see whether with bracket it works or not. No, with bracket it doesn't work. But what if I put minus? See, if I put minus, the issue with this is it will only take b as minus. I want the whole thing in minus. So in that case, just put the bracket. Just put the bracket and put minus figure outside like this. Because in this Excel, they will not take the bracket as a negative figure. They will take it as a text. And now just perform the sum function. What's happening here? They are taking this number as a text. So they are only showing this. So that's the disadvantage if you have the bracket. Okay. So in this case, you have to be a little smart. Since there's a b here, it will not take this as a number. Let me see whether we can format it to a number. Okay, you see. No, they will not take this as a this thing. So in this case, see, you only have one b. You will have a b in the end. You will be having a b. The base rate you will be having in your net result. The only thing is the difference between 1.1 and 0.02, which you can work out anyway. Even for a calculator, you can take it out. So it's 1.1 minus 0.2, which is 0.9. So you will be having a base rate plus 0.9%. So it's difficult to have the any function with the variable factor because b is there. So since it's like this, then you either take this like this, put it in bracket. And this also, what you can do is just go to format cell, and if you go to number and take it in terms of bracket, okay, see what's happening. They will show 0, but they are showing minus 6.9% here. So it's better we take it as minus. Okay. Or simply if you want to show this as bracket, you can do that also. In this case, you can't perform the function. Okay, you have to convert this into a text. Since this is a number, automatically they are taking the minus figure. Even if you are putting the bracket, they are taking it as a negative figure. So what you have to do is you can convert this into a text and then put the bracket. So in that case, you have to use a calculator to perform the function. Or in some other column, you can just take 6.9 minus 0.2 and just put that 6.7 inside a bracket. That also you can do, or you can show it like this as minus 6.7%. Anything is fine. Now, so here in bracket b plus, no equal sign, sorry, the bracket b plus 0.9%. Done. 0.90%. But make sure when you're writing this, this also is in the same manner. Okay. So what I would do is, I will put bracket next to this. See, automatically they are taking negative. So what I will do is I will go and format cell and I will take this as all or a text. Okay. Now 6.9%, you see, and now I will put it in bracket 6.70%. Done. But if you put minus or bracket, make sure they both are in similar method. You can't put one in minus or the other party in bracket. Both has to be in same. Since the answer also you see it's in bracket, I would prefer bracket because I think it's easier for you to recall in that way. If I put minus now, you might get a little confused because in the answer script, they are showing it in bracket. Bracket means it's a minus only since it's a payment. If it was an investment, if it is something that you are receiving, it's the other way around. Answer would have been in positive. Now swap. So for these things, you can easily write it in word processor under a table. There you can write in bracket. Now the swap. So you have to write what you are borrowing at. Borrows at. This is the first thing you will start with under swap if it's a borrowing. And what D company will pay and what K will pay. And finally the net result. Remember the net result at the end. The trick is here. The net result at the end has to be the same. It can't be different. If it's different, your swap is not working. Somewhere you have made a mistake. This is how you will decide. So now, what are you going to borrow at? Under the swap, they will borrow at what they are supposed to borrow at. See, here you are having an advantage in the D is having an advantage in the floating rate. So they will borrow at the floating rate under the swap. So floating rate is this base plus 0.2%. Okay, they will borrow at this rate. So since it's a bracket, again we'll put the bracket here. Okay, they will borrow at D company. Base rate plus 0.2%. Okay, they'll borrow at this. Now, if he borrows at fixed means he will borrow at, sorry, if he borrows at variable, he will borrow at fixed. It's in bracket 7.40%. Done. See, I have to format this as well. It's not formatted. So I'll go here, format cell, and I will take it as a text. Take this as text, sorry, I'm sorry. So 7.40%. Done. Now he will pay at what? You can just write the net result, copy, paste. Done. So when you are copy pasting this, this is becoming negative. So here you have to go and format the cell again and take it as a text. Done. Okay. Now, who will pay? See, one party will pay the fixed, one party will pay the variable part. That means one party will be paying the base rate, the other one will be paying the fixed rate. It is very easy. If you just look at the base rate, just look at the net result. Who is having the base in the net result? Who is having that B? It's K. So it's very common that K is going to pay the B. K will pay the B. Okay. So it's in bracket base rate, or you can just simply write B. Okay, by just looking at the answer, because D doesn't have any B in the net result, so D can't pay B. D will pay fixed rate. The variable rate, the B base rate component will be paid by K. B, done. You see? And what will D pay? D will pay the fixed rate. So he is paying B. See, for him it will be in bracket because K is paying the B. Sorry, K is paying the B, but for D it will be a positive figure. You have to show B in positive because he's receiving this B from K. That's why it's in positive without bracket. This is how it always works. Always. One party, it will be in bracket, the one who is paying, and for the other party, the same amount will be in positive because they are receiving that amount. They are not paying that. This is how swap always works. First, you have to always decide by who is paying, not who is receiving. Once it is decided, then you will know the other party will have the opposite reaction to that. So in this case, since K is going to pay for D, under D, they are going to receive this B. But you will write K pays only. You see? Now, what's next? Next is the balancing figure. You can either start from here or you can either start from this branch. Any branch is fine. So you see, now D will pay what? The net result is 6.7. D is borrowing at 0.2. So the difference among the two is what the D will pay. So it is simply 6.7 minus 0.2. They will pay at 6.5%. Okay, so 6.50%. This is the amount D will pay. So since they will pay, it will be in bracket. This we have to format it into a text. So in bracket 6.50%. And he will receive that same amount. So it's in positive. K will receive it. You have to take this as text. %6.50 done. So it's a text and OK. See, there is a mistake somewhere that is being done. It is 6.50% done. Okay. So now the problem is fixed. Now you can recheck this by using this. See, they are borrowing at this rate. D is paying in that rate. So just you need to add this two. If you add this two, it would be B plus 0.2 plus 6.5, B plus 6.7%. You have the 6.7%, but you have to eliminate the B there. So if he receives this B, this is payment. This B will cancel and you will only be left with 6.7%. So this side of the branch is done. It is correct. What about here? Here, K is borrowing at this rate and he's borrowing at this rate also. So that's when the answer you have a B and the difference 7.4 he's paying, but you should have 0.9. So 7.4 minus 6.5, the difference is 0.9. So B plus 0.9, that's what he's paying. You see, it's very easy. You just have to work out on the difference. So that's it. Now you are in a position to advise. Okay. So now let us go through the final answer, advise on the three methods, and also the first requirement has not been answered. That is A. Discuss the options for 5 marks. So let us do that as well. So now we have come to the final phase of this answer, that is advice. So when you are advising, you have to talk about all the three methods. Okay. So if you see the result, finally, let us summarize. Let us go through FRA. FRA, the rate is 6.8%. For future, it is 6.76, even less, and swap is even less, 6.7%. The net result of decompany you have to see. So now, but if you see, they are very similar. The difference are not so huge. 6.7 versus 6.76 versus 6.8. So that's why if you see all the three hedging methods are giving similar results. But in theory, what are they doing? They are all achieving a fixed rate. Okay, that means they are achieving a fixed rate means there is a certain cash flow that they are going to receive. But in practice, so now you have to talk about advantages and disadvantages. Now you start. So let's start with the future. Advantage and disadvantage. The disadvantages of future, if you compare the three, the lowest rate is under the swap. Okay, swap gives the lowest, and future is in between the forward and the swap. So the disadvantage of the future mainly is the basis risk. So this you should mention in your answer when you're talking about future. And also margin requirements is the next, where you need initial and variation margin payments. Next, we'll go to swap and forward. Why did we talk with future and why did we separate them from swap and forward? Because future is exchange traded, but swap and forward trade are not. Okay, they are not exchange traded. So they are not subject to margin requirement, both of them, or unlike option, you don't have to give an expensive premium also. But they both are exposed to counterparty risk. If the counterparty defaults, both under forward and swap, there's a risk. And the forward rate will be preferable since the intermediary who is the thought bar bank, they have given about it, right? They will bear the risk of the counterparty defaulting. In that case, see, if you compare the forward and the swap, forward is preferred. Why? Because in that, the counterparty is the bank who will bear the risk. Okay. And also, this will depend on the finance director's assessment of their bank's default risk. So by just writing this, you are going to get your professional skill marks. Why? Because you are showing the examiner that you are seeing the bigger picture. You are linking this to the bank's default risk. You are seeing, you are evaluating from all the available exhibits. Number one. Number two, you are having a good commercial acumen. So you are doing a good analysis here. That is what you are showing the examiner. You see, just writing straight away just the figure that this is the highest or this is the lowest, we should go by that. This is how you have to evaluate your answers. Just by giving one line is not enough. Yes, you can give that recommendation, but at the end, after you have evaluated all the options, and this is how you do it. Okay. So if you see under swap, finally we'll talk about the swap. Counterparty risk is higher. Why? Because in that no bank is involved. You see, the D company has agreed the swap itself, so they have to bear the counterparty default. So there is no intermediary who is going to give a guarantee. There is no bank in between. Usually you see some cases there is a bank fees also. Under some questions for swap you must have seen in the past. There are bank fees that is charged that has to be deducted. In this question it is nothing like that because there is no bank. D himself is uh, finding the counterparty and going for the swap. So now final comes the conclusion. So you have talked about forward, You have not talked much about forward because already the figure is given. That's why we started talking the disadvantages of future, and then we went to the swap and compared it with forward. Why? Because they both are not exchange traded. That's why there's a similarity between them, that there's a counterparty risk. They're not exchange traded, but they're counterparty risk. And who bears the counterparty risk compared to swap and forward? Swap, because no bank involved. So that's what we have talked about this. And then finally we are going to come to a conclusion. So even though FRA is expensive, it's marginally more expensive than the swap. Why? If you see, the rate here is 6.7 under swap, but forward it is 6.8. Okay, even though it looks 0.1%, but still. So it's marginally more expensive than swap, but forward is straightforward. So now you are giving the advantage of, see, you often start giving advantages of a particular method if you want to conclude that that is the method that you are going to choose. This is how you're going to end your answer. Ending is very important. Okay, many students often struggle how to bring about everything. For example, your answer could be anything. One of you might go by forward or future or swap, anything, where you have to give your reason, and if you have given your correct reason, you will get the marks. Okay, so here, because they want to end that they are going to choose the FRA, that is forward rate, that's why they are talking about this. Even though, so on the one side you are showing disadvantage, but you end with the advantages. You will only give one disadvantage and then you will give number of advantages. That's how you end it. Okay, so even though FRA is expensive, it is straightforward method. Number two, certain cash flows are there and also counterparty risk is reduced because bank is involved. Okay, so now finally you have to link this to the D company's board. Remember I told you they are risk averse, the board. Now this is the time you have to link. This will show you, this will give you your professional skill marks because you're able to link between the exhibits to the case study very well. So this forward will be more attractive to D company's board because it aligns with their high risk aversion also. Forward is less risky as compared to the other two. And they are risk averse. Risk averse means they do not want to take so much of risk. They want to avoid risk. So in that case, FRA is recommended. Whenever they ask you for a straightforward conclusion, you have to give one method. Sometimes they might just tell you to evaluate, where you cannot come to a clear cut conclusion. Then there you have to leave the choice to the director or the board of directors. You can say, you can conclude by saying that it is up to the board, their risk position, whether they will go for this or that. But in this case, they have clearly told you that you have to come to a conclusion. How do you come to a conclusion? You align it with the board's risk appetite. They are risk averse. If they were risk seeker, the answer would be different. It would not be forward. They might have got for swap or future. Okay. So this part is over. If you see the answer, it's like this. I've gone through all this. We have done. And then we have done the future, then FRA, and now we are coming to part A, where we have to answer for 5 marks. So in this case, the government, okay, so in this case, the government is funding the generation project. Okay, so since the fund is originate from the taxpayer, government is accountable for any spending decisions. They will be accountable, and already they have been criticized. So the new reward system will reduce the potential for additional overrun and avoid some criticism also. So this will align by aligning the director's incentives with the overall attitude to risk and also for cost control, because it aligns with the government's objective for cost control also. Now, so the both risk aversion, because both are risk averse, that's why you have gone to this new incentives. Okay. So now you have to talk about the disadvantages of options. So because you are risk averse, that's why you are preventing it from considering options. Even when upside potential is huge in option. That means in option there could be a huge cost saving, but still you're avoiding option. Why? Because you are a risk averse decision maker. You will always choose a fixed over variable. where the downside variable outcome is lower than the fixed rate. This is true even when there's an upside potential also. So the option premium, one thing about option you can talk always is option premium. This, if you can remember, it is very easy for you to answer. So the option premium is very significant. It might even outweigh the benefit also. Okay, and also it will be more expensive than the alternatives under the worst case scenario. Okay, so in summary, any gain from the upside will be outweighed by the board's requirement to control the cost if the worst case scenario happens. Okay, so there might be gain on the upside, but that still it will be outweighed by the board's requirement because they want to control the cost. So in that case, they will not go for the option. So that's it for question number 3. And with this, I have finished all the 3 questions of AFM pre-mock September 2025. Question number 1, question number 2, question number 3. So in question number 1, I have talked about acquisition and merger, where we have used the cash flow, the PE ratio to value a company. And then question number 2 is on net present value. And finally, this question is on interest rate risk management. So now with this, now you have an overall idea of what areas you need to focus on, where you have to start studying, where you're lacking, what are your strengths. Please make sure that you work out on these areas and at least do 3 mocks. 3 mocks is required of you. So this is one I've done. You can pick any 2 mocks from any year, any past paper. Make sure that you do the recent papers, okay, the recent years, if you don't have so much of time. So today is 31st August, as not much time is remaining there. Let me wish you best of luck for your exam, and make sure, even if you're not able to finish the revision kit questions, do not worry. You still have few days left to at least attempt at least 2 mocks, if not 3. I always go by 3, but if not 3, then at least 2 mocks, and make sure that you get it reviewed by an expert. Thank you once again, and do not forget to subscribe to my channel if you haven't subscribed, and do comment me below if you want to watch out the mocks for the other subjects as well. If you want me to solve the mocks for the other papers like SBR, ATX, AAA, let me know in the comments below. Thank you.